If you could lessen Bitcoin risks, would involvement in it seem more appealing? You may have heard the cryptocurrency space referred to as the Wild West because of the instability investors face. While things are getting better as investors become more knowledgeable, many have paid a heavy price for the education. What gives monetary instruments value is the belief people have that they are money. And today, Bitcoin is gaining in popularity as yet another monetary instrument. So, let's take a closer look at its value and its risks. Value of Bitcoin. Bitcoin derives its value based on supply and demand. And unlike stocks or bonds that bring in future cash flows, interest, and principal income, Bitcoin's only source of return is price increase. In the last year, the price of Bitcoin more than doubled its value in less than 2 months, then dropped back down. Can you imagine if the US dollar, the Japanese yen, or any other currency did the same? The economies of those countries would plunge into an inflationary spiral. Bitcoin is decentralized. Bitcoin has introduced a new category of money. Now we have digital currencies based on a combination of cryptography, economics, and game theory. Decentralized Bitcoin removes the fear of a single omnipotent entity that controls the money supply and governing rules. The blockchain serves as an online ledger that records and validates all peer-to-peer payments to eliminate double spending. This negates the need for a controlling entity. The blockchain both thwarts centralization and checks inflation with scarcity, as there will only ever be 21 million Bitcoins mined. Is Bitcoin risky? So, if this cryptocurrency is so revolutionary, ingenious, and potentially disruptive, why is investing so risky? It narrows down to a couple of issues. First, cryptocurrencies are easy to lose. Uninformed investors that fail to learn proper security practices put their coins at great risk. It's the one monetary space where individuals must accept full accountability for their own actions. There's no safety net or recourse for mistakes. The second issue is that Bitcoin is still a new, emerging technology, and no one really knows the impact it'll have in the future. Government regulations, limited adoption, volatility, and lack of liquidity are all risk factors. Maximize Bitcoin potential. Those seeking to lessen Bitcoin risks must dive deeper than the surface reports and hype covered by the media. Millennials are much more likely to invest in cryptocurrency because they have an overall distrust of the stock market or traditional investments. The message is appealing to millennials who saw their career prospects dwindle during the financial crisis before they ever really entered the job market. Millennials are also highly tech-savvy and have no fear of this revolutionary new currency. Smart investors in any asset realize the importance of resisting the temptation to jump in at all-time highs. Waiting for market fluctuations and buying the dips is one way to lessen Bitcoin risks. Investing in a physical hard wallet to avoid holding cryptocurrency assets on exchanges eliminates the risk of hacking. Contrary to popular belief, exchanges and individuals get hacked. Back in 2010, 1 year after creation, someone was able to create Bitcoins out of thin air. Developers at the time deployed a soft fork to fix the bug, and the crisis was averted. Since then, Bitcoin has been attacked, but hacking efforts have been unsuccessful. The price was about 8 cents at the time. The fact is, it's still a good time to invest in cryptocurrency, particularly Bitcoin. While the market will go up and down, drops will cause panic sells, and peaks will cause impulse buys, you can't argue with the tremendous gains already realized. The key is not to invest an amount you can't afford to lose. If you'd like to learn more about Bitcoin, then come on over and visit our site today. And if you enjoyed this video, don't forget to like, comment, and subscribe.